In the last 2 years, it seemed like real estate prices would never fall. It kept rising like there was no tomorrow. It was one of the significant rises in house prices in the history of the market. Imagine an asset that rises in value by 1 or 2% and suddenly rises by over 20%. Whoever got a mortgage in 2020 took one of the best decisions of their lives. Not only did the price of your house appreciate dramatically, but you also fixed your mortgage rate at a historically low rate. Buying a house with a low mortgage rate is probably one of the best ways to build wealth. You are going to pay for rent anyway, so why not pay for the mortgage and generate wealth over time, even if you aren't going to live there? If the mortgage rate is low enough, renting it out will not only cover the mortgage payments but also generate some income. But that has changed in the last couple of months. As the Fed is tackling inflation, house prices are beginning to shake. A 3% mortgage rate is no longer available. 5 or 6% is the new normal when it comes to mortgage rates. A single percentage point already makes a huge difference, let alone 2 or 3%. In the United States, the average down payment is slightly more than 6%. A $500,000 house, including taxes and fees at 3%, would cost approximately $2,979. If we used the same house but a 6% mortgage rate, the price would jump to $3,824. The difference is remarkable, especially if you are planning to rent it out and turn it into a source of income. But that's just one part of the story, because the other is that house prices are declining. Experts were warning all of us that this was not sustainable, and house prices, one way or another, should collapse. It was turning into a bubble that would eventually burst. It's both good and bad news depending on whom you are asking. If you are a homeowner, you want to keep watching how the price of your house keeps rising. But if you are a home buyer, you can finally consider buying a house, since you don't have to bet and overpay for your house. So let's find out. Will house prices keep declining? Will the market completely collapse by the end of the year? Is it the right time to buy a house or not? We will answer all of these questions and many more. But before we do that, give this video a thumbs up. Let's look at what happened in short. When the pandemic hit the world, the Fed was so worried that the economy would collapse that it instantly lowered the rates to literally 0%. Especially after March's stock market crash, low interest rates led to low mortgage rates, which pushed demand to increase. At the same time, the pandemic slowed down supply chains, which created a shortage of materials in the market and decreased the supply of houses in the market. On top of all of that, people were worried about selling their houses since the future seemed unpredictable, which further lowered the supply. And what happens in a market where there is so much demand but so little supply? Prices shoot through the roof. It seemed like a bubble in the beginning, and it is to a certain extent, but there is always a ceiling to how high prices can rise. Now let's ask a different question. What happens when mortgage rates rise? Not only will that slow down the demand, it will also push banks to approve smaller mortgages. Let's go back to the example we talked about in the beginning. If the bank would have approved you a $3 Kelvin payment on your income at 3%, you could have got a $500,000 house. But now at 6%, you can no longer afford $500,000 because at a 6% mortgage rate, you have to make enough money to be able to make a $3,800 monthly payment, which again lowers the demand and eventually leads to prices declining. But not everything is so crystally clear. How would prices keep declining when there is worldwide inflation for the reasons we have already discussed in one of the previous videos? A general increase in prices will increase the price of materials to build new homes, which will overall increase house prices. Inflation isn't going to stop anytime soon. It will take the Fed at least a year to reduce it to 3 or 4%, regardless. If we look at the numbers, the median house price has already decreased, and this has a psychological effect. When house prices are rising, people rush to buy homes, afraid that if they don't buy now, they will have to overpay in the future. But the absolute opposite happens when prices are declining. When people realize that prices are cooling, they wait until they reach their bottom line. The only problem is that no one knows where that bottom line is. That eventually leads to lower demand, which pushes prices to decline further. The Fed is playing with fire here. It's trying to control inflation but at the same time not to cause a recession. It's a very dangerous game that can easily backfire. The question is, how high should the Fed raise rates to tackle inflation? Experts believe that the Fed should raise interest rates to at least 2.5% in order to reduce inflation to a meaningful level. Imagine if a 0.25% increase in March already caused such a huge spike in mortgage rates. What kind of spike will an increase of another 2% cause? The last time mortgage rates rose so swiftly was in 1994. Rates were less than 7% in late 1993. By December 1994, they had surged to 9.1%. A jump of more than 2 full percentage points in less than 12 months. Maybe the Feds are trying to play out a similar scenario here. Anyone who understands how the Fed works knows that it isn't going to drastically raise rates unless it's a disaster like the 2008 crash where the Fed had to raise rates to cool everything down. It was a mistake since that surge in interest rates created a catastrophe in the market. If the Fed was a bit more careful and slowly raised rates, that would bring house prices down over time. The crisis wouldn't have been so bad. So the Fed would rather let inflation run wild than slow the economy. That's why many investors believe that inflation will last for another 5 years. Maybe not at 8 or 9%, but something around 5 or 6%. There are many reasons to back that claim. And we didn't include there what would happen if China suddenly started a full-scale invasion of Taiwan. The shortages that war is going to cause are beyond anyone's imagination. Inflation is going to be so high that even if the Fed raises rates to 10%, it won't make any difference. Let's hope that never happens. The main question is, will the market crash by the end of the year? The answer is probably not. It's true that the supply of homes is back to pre-pandemic levels and mortgage rates are rising. But that's not enough. There was already a shortage of homes in the market prior to the pandemic. So restoring supply to the previous level isn't going to make a huge difference. Will prices keep declining? Probably yes. In fact, it's already happening and might continue to happen until the end of the year. But didn't a 20% increase in house prices create a bubble? Well, $1 out of $5 in the economy was printed during the pandemic. You can't expect to throw that much money into the economy and expect prices to remain the same. It's just one of the consequences of the printing press. After each crisis, there is a gold rush where everything rises dramatically. But then at some point stabilizes. We had our own gold rush. Whoever earned a fortune, good for them. Whoever didn't, well, maybe next time. But until then, give this video a thumbs up and subscribe. Thank you for watching, and I hope to see you in the next one.